Hello, students. Welcome to another section of Principles and Applications of Macroeconomics. Today, we will be discussing about savings and debts. And in this section, we'll be talking about savings and investment role in economic growth. We'll be talking about debts and financing government spending. We'll be talking about deficits and surpluses. All right, so I believe from our last section, we were able to discuss some sources of growth as identified by the economists, and we mentioned economic compatible institutions, investment and accumulated capital, available resources, technological development, and entrepreneur. All these were highlighted in the last section. And this section goes around investment and accumulated capital. That's the savings and debts in an economy. All right, so when we talk about savings, what really is savings? We can say savings is current income minus spending on current needs. What does this mean? We all have savings, and you have an income and you have a current need. And so when the little you remove aside to keep is referred to as the savings, which we can literally say is your income minus your spendings on your needs. So the remaining is the savings. Okay, so savings rate is savings divided by income. And when we talk about wealth, we are talking about the value of an asset after we've removed the liabilities. Going on, what is assets? Assets are anything of value that one owns. So that thing you value so much that you own, property, such as vehicles, houses, they are known as assets. In accounting, really, when we talk about assets, we have categories of assets. We have the fixed assets, we have the current assets, and so all these are things of value that we own, either owned by an individual or owned by a business. And liability Liability are the debts we owe. These are debts. Companies owe debts, even as individuals we owe debts. So this liability these are debts. And so when we now talk of the wealth of a company, the wealth of a business, the wealth of an individual, we would look at the value of the assets, we look at the value of the liabilities. The difference between these two is the wealth. And so now when we talk about debt, we have the good debts, we have the bad debts. And so as students, it will be of interest for you to know the difference between good debts and bad debts. All right, so now another thing that is good to mention is the balance sheet, which is a list of an economic unit's assets and liability. And when we talk about economic units, we are talking about assets. We are talking about economic units. We are talking about whether it is a business or a company, or a one-man business, or even an individual, as long as it's involving economic activity. All right. Now, going forward, we have a flow value, which is defined as per unit of time. And in this, we have the income in this range. We have the spendings, we have the savings, we have the wage. And a stock value is defined at a point in time. So your wealth is at a point in time, debt is at a point in time. And so when we now say the flow of savings causes the stock of wealth to change, that is, every pound a person saves adds to his or her wealth. So your wealth is determined by the amount of savings you have. how much is in your savings. It's not the amount of money you spend. No, it's the amount of savings that is you have. What is the value of your assets after you've removed the liability, which is the wealth. So the wealth is determined by the flow of savings. That is the amount of savings you had. So for an individual, a high rate of savings today leads to an improved standard of living in the future. And this is important to know as individual. Now, what are the reasons for household savings? In one of the sections, we are going to talk about the reasons for holding money. I think it was the last section. I can remember when we spoke about reasons why we hold money. Now we are talking about reasons for household savings. Why is there household savings? We have the life cycle saving, and this is to meet a long-term objective, more like purchasing a home, children's university fee, retirement. This is life cycle saving to meet a long-term objective. The next one is precautionary saving. This is for again, this is to protect against setbacks, against things you don't plan for. For instance, you save when you lose your job, you have a savings to fall back on until you have another job, or until you have a stable job. Now, another thing is probably there is an illness that you need to pay for. You save, maybe you have a surgery that you need to pay for, then you save to have this surgery. Another one is the bequest savings. This is when you leave an inheritance for your children or your offspring, when you leave an inheritance. But this is mainly common among people that has high income, that is the higher income group. This is mainly common about them. However, this is not to say that even an average income earner cannot leave inheritance. So, but then when you put savings together for your future for family members, or inheritance for your offsprings, is known as a bequest savings. All right, so going forward, let's analyze the life of Andy. The wealth of Andy is analyzed through this balance sheet, where we have assets and liability. Remember, we defined wealth as the difference between the value of assets and liabilities. So when we talk about assets, we have cash, we have the current account, which is also the bank savings. We have the shares of stock. We have car at the market value. We have the furniture at the market value, and then the liabilities now. Anderson's university rents, and then you have the credit card balance. Now, by the time you subtract this, even though you can see here that the assets, which is about 6,280 pounds, is higher than the liabilities. But now you cannot say that Andy is wealthy with 6,000 grand. No, you have to look at the difference. And the difference here is the net worth, which is the wealth of Andy, which is 3,030 pounds. And so now it is important as individuals to know our net worth, to know our wealth. Look at your liabilities, look at your assets, you'll be able to determine your worth. And so now this is a personal question. Individually estimate your personal and household net worth. Now, when you say, ask yourself what step you need to take to increase your network, to increase your network. Ask yourself what step you need to take to expand your network. And so if you want to expand your network, what are you supposed to do? It means that you have to do more investments on your assets, do more of assets and less of liability. And so we go on now. when we look at it, wealth changes when the value of an asset change, just like I mentioned earlier, that for you to increase your wealth, you have to increase your assets and ensure that you reduce the value of your liability. Now, what is capital gains? Capital gains increases the value of existing assets. And so if you check capital gains is when there is more gain in the value of your asset, that is higher value of the asset. And what is capital loss? When there is decrease in the value of the assets. So increase in the value of the assets is gains, decrease in the value of the asset, that's the existing asset, is capital loss. And so how do we now determine the change in wealth? Simply, we can say is savings plus capital gains minus capital loss. And why is it like that? You know, you have some assets and which increase in value, and you have some assets which decrease in value. For instance, say Andy has let's check the value of he has a car, he has a furniture, say for instance. And now when you now want to check the changes in the capital gains, let's say the value of the car increased to say 4,000, but maybe a part of the furniture is broken, say so it reduces to 450. So for the car, there is a capital gain from 3,005 to 4,000. That's 500 capital, 500 gain. While for the furniture, there is a loss of 50 pounds because there's a reduction from 500 to 450. And so if you now want to calculate the change in worth for Andy, if we know the value of the savings, you add it to the capital gains from his assets, and you remove the capital loss from his assets, and then we have the change in wealth. And this is about savings and capital gains. And there are some fun facts, which is as at 2020, it says that the average resident of UK has approximately 6,757 in their financial savings. That's the savings in the bank. In the event of an emergency, a large majority of the British population may actually be in a bit of trouble. That's one fact that is scary, I think. And another thing is that beyond this, it says 1 in every 10 UK residents has no savings whatsoever. That's one point to note. And so another thing is that in the UK, the average British person saves about 105.43 pence per month. And it says most UK citizens believe that income from a pension somewhere in the range between 10,200 to 42,000 per year is likely to sustain their livable retirement. Well, that looks like the British residents or citizens are contented with what they have. But that's some facts for us to know. So going forward, we're going to national savings. Countries too save, nations, they have their savings. And so macroeconomics studies the total savings in an economy. Here, we look at the household savings as one component. We look at business and government savings as another component. And this has to do with the definition of GDP, which if you remember in one of the sections, we spoke about the definition of GDP, and GDP is defined as the total output from the borders of a country. That's the monetary value of the total output from the within produced, or the total goods and services produced within the borders of a country. And so it says Y equals consumption plus investment plus government and plus net exports. Remember, we mentioned Y, which is the GDP, equals consumption. Consumption, if you remember, I mentioned in one of the sections that consumption is used to capture the household and individual spending, while investment captures business, and G, which is government spending, and NX, it has to do with the net exports, which is our imports minus exports. All right, going forward, yeah, you can, and this gives us the breakdown of the alphabets that are used in representing GDP. Okay, and so now there is a savings and also there is budget. What is a budget? A budget is an estimation of revenue and expenses over a specified or specific period of time. Governments have budgets, just as individuals or businesses have budgets. And so you estimate the revenue, you estimate the expenses over a period of time. Usually it takes them 1 year or well, just for a specific period of time. And so now when you now talk of government budget, it means that the government expenditure of, or the estimation of government revenue and expenses over a period, a specified period of time. And so in the government, we have the balanced budget, which is when the government spendings equals the net tax receipts. It is good to note that the major source of revenue for any government is from taxes. The taxes received from within the economy. And so when you look at the balanced budget, a balanced budget is when the government spending equals the net tax receipts. All right, so we have the government budget surplus and we have the government budget deficits. Now, what is government budget surplus? This is the excess of government's net tax collection over its spendings. So when the receipts is more than spending, we are talking of surplus. Definitely, even as individuals, we have budget surplus. You go to a mall to buy, you have a budget of £100 to spend in the mall, and then eventually by the time you got there, you are able to buy everything you budgeted for, but you now have £5 remaining. Say you were able to spend £95 instead of £100. It means that you have excess or surplus. And so it means that what you have, it's less than what you have spent. And so it's just the same thing is applicable to the government. When the collections, the receipts is more than the government spending. Now we have deficit also, which is the other way around, when the government spending is more than the net tax collected or the net tax collection. All right, and that is when we have deficits. Deficit is not always good. We have to mention that. So beyond government, as individuals applying this to our day-to-day life, it means that you should be able to balance your budget. Don't go for deficits. Always try, at least if you're able to make savings, it's fine. But if you're able to have a balanced budget, you have £100, then spend £100. Don't go beyond £100. If you are having about £150 instead of spending £100, then you are running on budgets deficits, which is something that happens a lot, actually. You see, sometimes you go to the mall and then you want to buy some things. You have a budget, you have a list when you are leaving your house, But then by the time you get to the mall, you start picking things, and then by the time you check them out and you say, oh, this is 200 pounds already. I only plan to spend 100 pounds. Then you're running on a deficit already. Okay, going forward, deficits and surplus. A deficit is a shortfall of revenue under payment, while a surplus is the excess of revenue over payment, just like I mentioned. Okay, so in the short run, if the economy is below potential, then deficits are good. Yeah, it's for the government. It's not as if the deficit is bad. It's not as if the deficits is a bad thing, really. In the short run, just like it's mentioned there, deficits are good because especially if the economy is working below potential. That is, if the economy has not measured up to where it's supposed to be, yeah, having some extra spending might be good to boost the economy. And so because deficits increase expenditure, moving output closer to potential. But in the long run, surpluses are good because they provide additional savings for an economy. So in the short run, just to balance things, yes, deficit is good, but in the long run, for a stable economy, it is good to have surplus. Okay, going forward, the government finance its deficits by selling bonds to private individuals. This is how government finance its deficits, and then also to the central bank. Bonds are promises paid to back the money in the future, to promises made to pay back money in the future by the government. And they are incentivized by interest rates. These bonds are often referred to as blitz. Okay, so the government uses bond to finance deficits. So we have types of deficits. We have the structural deficit, we have this cyclical deficits, we have the nominal deficit and the real deficit. This material, I want you to know, it's in your module. So when you log onto your module and you go to the principles and applications of macroeconomics week 6, you would see that there. And so you have the types of deficit as mentioned there: structural, cyclical, nominal, and real deficit. And then you have, okay, and then when we talk about whether a nation has a deficit or surplus, it depends on what is counted as the nation's revenue and what you categorize as its expenditure. So for surplus or deficit, it is determined by revenue and expenditure. All right. So we have actual deficit to be structural deficit plus cyclical deficit. Now, much of the current deficit is structural, and we have to continue to keep the economy where it is today because it cannot continue indefinitely. Why is it structural? When you look at the definition of structural deficit, it says that it's a part of the budget that would exist even if the economy were at its potential. So structural deficit happens a lot in a country. And so actual deficits, it says, when we look at the definition of structural deficit, it says for us to have actual deficit is the structural deficit plus cyclical deficit. But the structural deficit is mostly what an economy has. Okay, especially in the UK. That's what is operational in the UK because it keeps the economy at its potential. Investment and capital formation is the next thing we are looking at. Investment is good. It's the creation of new capital goods and housing. And firm buys new capital to increase profits. That's using the cost-benefit principle. Cost is the cost of using a machine or other capital, while benefit is the value that we have from using a product. So now, looking at it, we have debts and we have assets. Remember, we spoke about assets earlier, which we say that these are the things owned, what you own. I mentioned that it gives us from assets, we are able to have economic benefits from an asset. So a debt is accumulated deficits minus accumulated surplus. So you say a debt is a stock. Remember, we mentioned that, which is defined as points in time. Okay. And debt, as a summary, measures a nation's financial situation. You want to know the financial situation of a nation, go and check its debts. But then what I want you to do for this section, you have to know the difference between individual debts and government debts. When governments, they have debts, individuals have debts. So what is the difference between your debts as individual and the debt of a government? All right. Now you look at it. Governments live forever, but people don't. Governments can print money to pay its debts, but as individual, you cannot print money on your own to pay your debts. And then government own much of the debts to itself, to its own citizens. Why, as individual, you owe other people? Okay, so this is just showing the depth of the debt as the percentage of UK. You can see there from 1800 down to the 2000s, and that's to the 21st century, from the 18th century to the 21st century in the UK. You can see the debt percentage. So the debt percentage rose around 1960, and now it's rising again of recent, where we have the comparison of the debt percentage of GDP of countries. So now you can see that Japan has more debts among all countries of the world. So UK is below 100%. That's you can see different countries there. Yeah. And then we have the class activity, which is given you when you check the module is given in the module. You can go over the class activity and have a quick knowledge of what we're doing today. And all right, so today we've been able to learn what's it's an asset. We've been able to learn what liabilities are. We've been able to learn what reasons for savings. We've been able to learn even the meaning of savings. We've been able to learn government budgets, the government, the meaning of the government's deficits, meaning of government surpluses. We've been able to understand the difference between debts and savings. We've been able to talk about the types of deficits. We've been able to discuss the difference between individual debts and government debts. All right, so thank you very much for attending to this section. We'll see you next time. Bye.